afternoon. On behalf of Reliance and Cohesion, I warmly welcome all of you. Really appreciate all of you coming from different parts of the world and making this event a success. I hope we can reciprocate by making relevant return in your portfolio for this afternoon, which you are sparing for us. So, in the interest of time, we have a very brief presentation. It lasts 20-25 minutes as far as I'm concerned, and Sunil will take over and he'll spend 20 minutes with you guys, and then we'll have a question and answer session. This is what we are going to talk about. This is what I'm going to talk about. We have, obviously we are operating in a world wherein it becomes very important to understand what is happening in the world. So we have three big things which we are currently looking at. One is the world is shifting away from monetary policy to fiscal policy. We have had a lot of monetary stimulus around the world in the last 4, 5, 7 years, but now it is turning towards fiscal. Then we have deflation, which has been talk of the world for last so many years. We are hopefully moving towards inflation. And we had a free trade and labor mobility. Now we are moving towards anti-trade and anti-immigration. Obviously, it has got huge implications for asset classes across the world, including what happens in India. So when we invest in businesses, when we invest in companies, we take due recognition of these factors which are developing, and we keep a very close track of what is happening globally. So, this is what makes us most bullish about India. This is the only slide which is most relevant. So if you see interest rates around the world are set to rise. We are already beginning to see some amount of interest hardening up even in US, in other parts of the world. In India, it is set to fall. In the last 1 month, while US interest rates have gone up from 1.3% of the low to 2.23%, in the same time, the bond yields in India have fallen by 40 basis points. Growth is subdued, to say the least, across the world. In India, it is rising. So we are not satisfied or happy with 7-8% growth. We are aiming, our Prime Minister is aiming at 10% GDP growth rate starting 2019. Reform momentum, if at all, it is muted across the world, and it is gathering momentum. So I'll talk about it. In the last 70 years, one of the biggest reform which happened in India was last week, where we demonetized 500 and 1,000 rupee note, which was actually the complaint of the world, to put it in perspective, that people thought that it's black money, corruption, this is happening, that is happening. So it all get killed with one shot. You basically, whoever had this money, and if it is unaccountable, you will just keep holding that money, which will have no value. So that is the kind of reform which we are talking about. And let me tell you, it was not the popular thing to do, but this man had the courage to actually stand up and do this unpopular step. I do not think many political leaders in a democratic setup can afford to do something like this. Then you have corporate prospects across the world. All of you know it is weakening. Corporate profitability is going down. In our part of the world, it is improving. Demographics, clearly unfavorable for the whole world. It is favorable for India. We have one of the youngest population in the world, and it is set to become even more younger over the next 5 to 10 years. Debt level, the world is struggling. I don't need to elaborate on this. Our debt levels are not only moderate, but they are very comfortable. Growth, I spoke about it, and productivity, whether you talk of labor productivity, whether you talk of financial productivity, it is all rising in India versus it is falling across the world. So that is what actually makes India a unique case for standalone investment, and I will talk about that as I go forward. Now, it's very important to understand what has happened in the history, because I can come here and say that this is what is going to happen over the next 20 years. But what has happened in the last 20 years? So this is what has happened in the last 20 years, in spite of Narendra Modi not being there. in spite of this government not being there, in spite of all the problems which we faced. So our GDP has gone up by 5.5 times in dollar terms in last 20 years. The vehicle sold, these are just the number, has gone up by 10 times in the same period time. The per capita income has gone up by 4.1 times in dollar terms. The tourist arrival has gone up by 4 times, and the bank credit has gone up by 15 times in this time frame. What has it done to the market? See, this is for the people who feel left out, who missed the move and say that, we missed this because it went up by 5%. I just want to put things in perspective. We are not talking of making 5% return in this country or in these markets. Obviously, it comes with whatever risk it comes with. So if you see from 1996, the index was 3,300 and we are at 25,000 now. So we have had a roughly 9x return in the basic benchmark indices. Our portfolios in the same time has gone up 90 times. So again, you look at the GDP growth rate, how it has panned out over the last 4 decades. So it was 3.2% for between 70s and 80s. It was 5.4% between 80s and 90s. It was 5.7%, and then it was 7.7%. For this decade till now, it has been 6.8%. I'm pretty confident that we will surpass the growth of last decade. And if I just extrapolate, it's just a simple spreadsheet. It is not Madhu Kela thing. It's a simple spreadsheet will take me at least to $6 to $8 trillion of GDP over the next 7 to 10 years. We are at $2 trillion. Again, to put things in perspective, right now we are at $2.1 trillion in terms of GDP. We are roughly $1.5 trillion in terms of market cap. Normally, we have observed being investors for last 25 years that normally GDP to market cap has a 1:1 ratio. So when you go to $6 or $8 trillion of GDP over the next 7-10 years, the market cap should correspond. In good times, the market cap has gone even 1.4 times, 1.5 times of GDP. In bad times, it has been even 60% of GDP. But I'm saying on an average, if you take 1 time to GDP, the market cap will go to $6 to $8 trillion. So friends, there is no reason to feel left out. And that's why Sunil and I have chosen, in spite of whatever is happening back home, markets being very volatile, we didn't want to cancel this, we didn't want to miss this. He said that there is so much money still to be made. So we are going to go from 1.5 trillion to 6 trillion, 7 trillion over the next 7-10 years. Now you can do your own spreadsheet. If you are conservative, put a 6.8% growth, put 6% growth. So we'll reach there in 12 years. But if you are aggressive as I am, we'll reach there in 8 years. So that is the difference is only that much. And when I come in this part of the world, where people are struggling to make 0.25% return. Someone was telling me yesterday night that in countries, just 3 months back, keeping money in the bank was very expensive. So people have hired go-downs to keep cash. When I tell all this story to my Indian entrepreneur friends, they are actually amazed that how the bank is offering you 0.25% return and still trillions of dollars are being kept in the banks. So, again, what we did, we actually analyzed the countries which have grown between 6 to 8%, and there are many which have grown for 20-25 years, and I'll dwell upon that. So we found there are 2 things. One, you need, apart from a lot of other cosmetic things, the most important things are favorable demographics and gains in productivity has to be possible. And when we look at this chart, which is whether it is Singapore, Taiwan, Korea, China, Malaysia, and now India, a lot of these countries have grown between 6 to 8% for 20-25 years. And when we analyzed going back in the history of the growth of a lot of these countries, we found those 2 factors. One, favorable demographics, and second was gains in productivity possibility. And the other thing which we found was, once the growth momentum starts, then normally it doesn't fade away in between. It's like a music, once it starts, doesn't stop in between unless someone really pokes to stop the music. So I think we have just 10 years past to get into this kind of growth of 7-8%. So we will have, going even by the average of these countries and keeping in mind that the favorable demographics and the productivity gains are here to stay. So we'll have at least 10, 15, 20 years of this kind of growth possibility. And I'm happy to discuss one-on-one more in detail as to what makes us so convinced. And for most of you who have come here in this afternoon, this is the most important thing to get right. If you are convinced that India is going to grow and there is a case for this kind of growth over the next 10, 15, 20 years, then I think making an investment decision becomes very easy. Then you will not bother about, oh, I missed this because the pound went down and I missed this 5-10% move. So I do not think in a larger perspective these things matter. So I talked about it, this demonetization. Let me just explain what the government has done. And I say this, living in India, managing money for 25 years, Spike very humbly spoke about what we have been able to produce. According to us, this is the biggest reform we have seen in this country in last 70 years. It doesn't get bigger than this. So what the government has done, that anyone who was holding 500 and 1,000 rupee note, if you made that money legally, and if you are holding that cash, let's say a lot of small people, like my wife has 200,000 rupees, but we withdrew it from the bank, so we can go and deposit it, because there is a slip which proves that I've taken this money from bank. Let's say my driver, who didn't have a bank account, and if he's holding $200,000 rupees, he can go and deposit it. So anyone who made this money legitimately can go and deposit it. But anyone who made it illegitimately, and if it is called, whether it came from corruption, whether it came from black money, whether it came from drugs, whether it came from any kind of speculation which you did in the market and for which you have not paid taxes. So the government has an option that you could have paid 45%. We had a voluntary disclosure scheme which ended in September. So at that time, our Prime Minister gave that opportunity to people that you can go and deposit this. But the people who have not been able to do that now will have to get penalized by 200%. So not only you have to pay 30% tax at the highest level, but you have to pay 200% penalty. Now it is a criminal offense. If you are found holding cash which you cannot explain, it's a criminal offense. So that is the level of changes which you are talking. Obviously, it makes me very bullish, as I said, in the long term, but these things have their own repercussion in the short term, and that may last for 1 quarter or 2 quarters, but I am sure those things will get adjusted in this time frame, and in the longer run, there will be much, much more transparency. Foreigners will feel much, much more confident. There will be a lot of money. We are expecting at least $150 billion to come in our banks over the next 1 month, because that is the amount of cash which is held by people. So you can imagine if $150 billion comes. Right now the bank deposits are roughly 80 lakh crores, what is 1.3 trillion dollars, and we are talking of $150 billion of addition to bank deposits. So I thought I'll just take a moment and explain this. Again, apart from this, there are a number of things which are happening and which has been initiated in the last 2 years. You have a taxation reform, you have a power reform, you have financial inclusion. Just the numbers are so staggering. We have had 250 million people open bank account in the last 24 months. I'll just repeat. It's bigger than the population of many countries here. 250 million people opened bank accounts in the last 24 months. So that's kind of inclusion which we are talking about. Then we had banking sector reforms, that the government has taken all the non-performing assets by the chin, and they are resolving that. There is agricultural reform, the first time the farmer can actually go and insure their crop, and the government is paying for it. Then you have Make in India, which is again one of the biggest thing initiated by our Prime Minister, where it's actually a matter of shame, and I don't say it in a negative sense, that the tear gas, something like a tear gas, is imported in India. It can't get worse than that. On one hand, we are sending our people to moon, and on the other hand, we are importing tear gas from other countries. So this Make in India program will ensure that these things are produced in India, if you have to import the technology to produce them, and it is estimated roughly $50 billion of manufacturing will happen over the next few years under this program of Make in India. There are various policies which are being initiated. So all the work which is happening is about the policy framework in the last 3 years, and it will start to bear fruits over the next few years. Now if you see, there are a lot of people are concerned about currency, because obviously some people, like ma'am told me that she had a very bad experience investing in India, because once she invested and the currency went down. So every day is a new day in investment world, so you should have no biases of what happened 7 years back. And just because you invested in some other fund, it's like you were wanting to go to a doctor, but 7 years back some doctor mistreated you. So you are saying that I'm happy to be ill, but I don't want to go to a doctor. So it doesn't work like that. So Indian currency actually has been the strongest currency in last 2 years after US dollar. I'll repeat this. It's been one of the strongest currency after US dollars in last 2 years. Obviously much stronger than the British pound. So this is basically you can see what has happened to other currencies and what has happened to Indian currency. And again, we analyzed it for the last 25 years. Currency is directly proportionate to the growth. So if we have a strong growth in India, the currency remains strong, a strong real growth, not including inflation. And if you have a weak growth, the currency gets weakened. And in that 5-year period, when you happen to lose money because of currency, we had a very weak government, and obviously macro things were not looking up. And that is what was responsible, but the things have changed. Trust me. This is what I said, that growth and inflation trade-off determines the performance of the currency. And this is again proven not in a 3-6 month time frame, but it is proven over the last 20-year time frame. See again, growth differential with the rest of the world has just started to rise. So whether you see global, whether it is developed market, whether you see emerging market, and you see India, this chart clearly explains that our growth differential had actually dipped. We had come down to a level of all emerging market growth, but the last 2-3 years, again it has started to differentiate. So these are again spreadsheet numbers, please don't hold me. Obviously I believe in this, and it is future. So what I did, what is the possibility? So if we just extrapolate our conviction of 8% growth, so we will be $10.3 trillion by 2036, and will be $5.3 trillion. This is on a relatively conservative basis, real growth I'm talking, will be $5.3 trillion in terms of GDP over the next 7, 8, 10 years. And I think, whenever I met people in this part of the world, the people are actually willing to take a long-term call if it is being explained properly and if it makes sense. So we have seen investors who have we have been interacting with, and they have remained invested for a 10-year or a 15-year time frame, even in equities in individual stocks who are coming from outside India. So that takes me to what is the outlook for the markets. So we are clear that the growth in corporate profitability is set to take off, and we believe that CAGR of around 18 to 20% in corporate profitability is possible over the next 3 years after a relatively dull period between 2008 and 16 of 6% CAGR for corporate profitability. Equity valuation, again, this is one of the complaints of a lot of foreign friends of mine, that yes, what you're saying makes a lot of sense, but the markets are extremely overvalued. So now, after this correction in the last 10 days, and the friend who was sitting in the right side of table, he had a complaint that I missed it because of the Brexit, so now you're getting it again. And the markets have come to a mean multiple of our long-term average multiple, where we trade, where we have traded for 20 years. This is, again, if you look at where the investments of individuals in India are, so now this is what the demonetization will do this thing, that people have invested 56% of their money in real estate, 12% of their money into gold, 15% of their money into bank deposit, but only 2.8% of the money locally is invested in equities. We believe this number is set to rise very, very meaningfully, and it will make a tremendous impact on the markets, because when we are talking about GDP, our GDP is 2 trillion, and we are talking of roughly 25% of financial savings. So we are talking of $500 billion of saving every year, but this money, rightly or wrongly, was not coming to equities, but it will come to equities, and we have already started to see that. So the mutual funds have started to get at least $1 billion every month flow in equities for last 12-18 months. Again, if you look at the market composition, unlike Russia or Brazil, a lot of other emerging markets where there are only 5 or 10 companies, there are only 2 or 3 sectors to invest in, India has a very diversified sector, which is exports, global cyclical, domestic demand and capex related, and utilities. Again, this is the reason why Indian market will continue to trade at some premium as compared with other emerging markets in the world. And this is the point which I want to make. This is the last point. I have 2 minutes more. As an investor, the biggest thing which I run is to differentiate what is the difference between risk and volatility. And when we buy individual companies, even we get scared when we buy something at 100 rupees and the price goes down to 80, 90. But over the period, we have learned to differentiate that if it is a volatility, then it is my biggest friend. I must take biggest advantage of that volatility. Because if I want to pay something for 100, if it is available for 80, I should be happy. I should not be unhappy because I invested some part of my money at 100 rupees. I can invest much, much more at 80 rupees. So while we have made 90 times return in the last 20 years, we have had period when the NAV has contracted as much as 30, 40, 50%. But I don't call it risk. I call it volatility. Because the longer term trajectory of the country and the corporate sector is very positive. So the people who miss out, actually there is not much to discover for India. Whatever I spoke, most of it is known. The only advantage which you can get is when you discover this, that if the prices have fallen and it is because of volatility, then we can take advantage of that. So maybe what is going on right now over the last 10 days, because of demonetization, because of some risk of trade in the world, and because of the bond yields rising across the world, there is a little bit of sell-off in the emerging markets. So maybe these are again the kind of times when we look back 2 years down the line, we'll call it was volatility and it was not risk. And that's the reason why we are here. Just in conclusion, I would say that a lot of you are allocating already money in emerging markets. Our recommendation is that you start to invest maybe 0.5% of your portfolio in India, and let it be on a standalone basis. So you start interacting with us, you start tracking that investment, and if you invest small money, then again, our experience is then you can take a much longer horizon. And time and again, it is proven, only when you take a longer horizon, then only you make real money. And we are very confident, regardless of what happens in the world, regardless of what happens to the broader market, there are a lot of good companies, there are a lot of good businesses which are available at attractive valuation, which if not 30% compound return over the next 20 years, I can't guarantee that, but we are still confident that Indian equities, even in dollar terms, over the next 20 years, will be one of the best asset classes to invest in. I must hand over to Sunil, waiting. Thank you very much.